There's a reality about your bank account that exists in the shadows, and the vast majority of account holders remain completely oblivious to it. Embedded within the contractual language defining your deposit account, there exists a provision. It has remained in place for generations. The majority of customers have never encountered it. Banking representatives rarely volunteer its existence, and commercial financial broadcasting avoids addressing it because acknowledging this provision contradicts the stability narrative they're incentivized to perpetuate. That provision authorizes your financial institution to postpone your cash withdrawal for up to 7 calendar days, not to permanently restrict access, not to indefinitely block transactions, but to implement a temporary postponement without providing justification, without generating crisis coverage, without any public disclosure requirement whatsoever. This isn't hearsay. This isn't conjecture. It exists in codified federal banking regulations under Title 12, Part 204, Regulation D, which establishes governance over deposit accounts at every commercial bank, every credit cooperative, and every savings institution across America. The specific language states that a depository institution maintains the authority at any moment to demand 7 days advance written notification of an anticipated withdrawal from a deposit account. Those represent the precise regulatory words. Most account holders never confront this language because they never examine the contractual documentation they acknowledge when establishing an account. But the provision exists, it remains currently enforceable, and its inclusion was deliberate. What this provision signifies extends beyond mere technicality. It functions as a release mechanism, an instrument that exists specifically because the architects who constructed the banking infrastructure understood that eventually, under specific conditions of financial pressure, they would require an instrument capable of moderating outflow velocity without necessitating a formal crisis proclamation. An instrument that functions beneath the threshold of public awareness. An instrument that creates temporal buffer. What I'm preparing to demonstrate today isn't a market collapse, it isn't widespread panic, and it isn't unsubstantiated rumor. It represents a progression, a discrete procedural progression that initiates with a legal structure most depositors remain unaware exists, develops through the particular financial pressure currently accumulating across banking institution portfolios, and culminates at a juncture where the determination of whether you can retrieve your own capital is no longer exclusively yours to control. I have dedicated years observing these progressions materialize. The institutional names transform, the catalyzing circumstances transform, the media coverage transforms, but the underlying mechanics remain constant. And once you comprehend the mechanics, you cease waiting for media coverage to signal something has initiated, because by the moment the coverage materializes, the initial 3 phases of the progression have already transpired. Let me establish the historical foundation because you cannot comprehend our current position without understanding where this infrastructure originated and why it was constructed in this specific manner. The year is 1933. The American banking infrastructure has been disintegrating for 3 years. Between 1930 and 1933, exceeding 9,000 banking institutions collapse. 9,000, not merely weakened, not rescued, not reorganized, collapsed, terminated. The accumulated savings of millions of Americans evaporated. Not because they depleted the capital, not because they executed poor allocations, but because the institution maintaining their deposits exhausted liquid resources to satisfy withdrawal demands. The capital existed on documentation. It was unavailable in physical currency. And once additional depositors comprehended that the institution could not satisfy everyone simultaneously, the withdrawal acceleration initiated, and the acceleration guaranteed the outcome it anticipated. What followed represented a fundamental reconstruction of the relationship between depositors and the banking infrastructure. The Federal Deposit Insurance Corporation was established. Deposit protection was introduced, reserve obligations were restructured and integrated into the precise definitions establishing what a deposit account legally constitutes. Regulators inscribed a reservation of authority for institutions, the authority to mandate advance notification before releasing capital, not a permanent authority to refuse, a temporary authority to postpone, a valve mechanism. For the majority of the subsequent 9 decades, that valve mechanism remained dormant because the infrastructure was functioning within its design specifications. Withdrawal accelerations occurred at individual institutions but were contained rapidly. The FDIC would intervene, compensate insured depositors across a weekend, and the infrastructure would persist. The valve mechanism was a redundancy, comparable to a fire suppression infrastructure in a structure that has never experienced combustion. You cease acknowledging its presence. But then the thrift institution emergency materialized in the 1980s, and what it revealed was that the infrastructure constructed following the Great Depression contained a vulnerability. It could manage individual institutional failures. It could not readily manage systemic failures across an entire sector of the banking industry. Between 1986 and 1995, exceeding 1,000 thrift institutions collapsed across America. The Resolution Trust Corporation was established specifically to manage that devastation. Taxpayers absorbed exceeding $120 billion in losses, and regulators initiated designing a more permanent solution to the question of what transpires when the emergency is too substantial for the insurance mechanism alone. That solution materialized fully following 2008. And this is where the narrative becomes immediately relevant to the capital you maintain positioned in a deposit account currently. Following the global financial emergency, the Financial Stability Board, which represents the international entity that coordinates financial regulation for the G20, published a revised framework for resolving failing institutions. The fundamental principle of this framework was that the expense of an institutional failure should be sustained primarily by the institution's own stakeholders, not by taxpayers. The framework is characterized as bail-in as opposed to bailout. In America, it's embedded in Title II of the Dodd-Frank legislation under what's characterized as orderly liquidation authority. In the European Union, it's the Bank Recovery and Resolution Directive. In the United Kingdom, it's the Banking Act of 2009. In Australia, Canada, and across the G20, variations of this identical framework are currently law. The Financial Stability Board coordinates its implementation across 24 jurisdictions internationally. Here represents the specific mechanism. When a systemically significant financial institution enters a resolution procedure, the FDIC or equivalent regulator assumes control. Shareholders are eliminated first, then subordinate bondholders absorb losses, then senior unsecured bondholders, and then if additional capital is required to restore the institution's viability, uninsured deposits exceeding the insured threshold can be converted into equity ownership. Not withdrawn, not returned, converted. You become a shareholder in a recapitalized version of the institution that just collapsed. Your claim on currency becomes a claim on equity in a restructured institution that may require years to fully resolve and may return cents per dollar. This was tested in actual implementation in March 2013. Cyprus, the two largest institutions in the nation, Bank of Cyprus and Laiki Bank, were restructured under a procedure coordinated by the European Central Bank and the International Monetary Fund. Depositors with balances exceeding $100,000 lost up to 47.5% of their savings. Those resources were converted into institutional equity. The institutions reopened on a Monday. Depositors who had maintained accounts their entire existence discovered that the regulations they believed governed their capital had been rewritten across a weekend. The Financial Stability Board's documentation from the interval following Cyprus characterized what transpired as a successful proof of concept for the bail-in framework. Those words exist in their published documentation, not concealed, not classified, published. The template was formally codified, the framework was expanded, and the legal infrastructure that permits depositor resources to be converted into equity during an institutional resolution currently governs every major Western economy globally. Now, let me explain what this correlates to where we are in early 2026, because the conditions that transition this infrastructure from theoretical to operational aren't hypothetical projections. They're currently positioned on institutional portfolios across America, and the metrics are public. As of the conclusion of 2024, according to metrics published by the Office of Financial Research, aggregate unrealized securities losses across all FDIC-insured institutions in America stood at $481 billion. That figure represents approximately 19.9% of the aggregate equity maintained at banking subsidiaries nationwide. Nearly one-fifth of the complete capital buffer that's supposed to absorb losses in the banking infrastructure is positioned in paper losses that don't materialize on income statements because the holdings are designated as held to maturity and therefore don't require mark-to-market valuation unless they're liquidated. By spring of 2025, as documented by Fortune, that figure was approaching $500 billion as the 10-year Treasury yield increased again in response to renewed inflation pressure and the uncertainty introduced by the tariff environment. A Stanford finance professor who has functioned as an expert in systemic banking exposure told Fortune directly that at a 10-year yield exceeding 4.5%, the banking infrastructure begins experiencing serious challenges. At 5%, it becomes quite severe. As of this documentation, the 10-year yield is precisely in that zone. This matters because of what transpired at Silicon Valley Bank in March 2023, and more importantly because of what SVB revealed about the structural vulnerability shared by hundreds of institutions functioning within the identical infrastructure. SVB was not a rogue institution. It was executing what hundreds of regional institutions were executing during the zero-rate era. It was acquiring long-duration treasury instruments and mortgage-backed instruments to generate yield on deposits that were expanding faster than loan demand. When interest assessments increased sharply in 2022, the market valuation of those instruments declined. The losses were unrealized. They were disclosed in portfolio footnotes that most depositors never examined. But when confidence deteriorated and depositors with substantial uninsured balances initiated relocating resources, SVB was compelled to liquidate instruments to satisfy the outflows. The moment it liquidated, the paper losses became actual losses. The actual losses destroyed the capital buffer. The regulators materialized on a Friday. By Monday, the institution had ceased existing. The Office of Financial Research published a brief in May of 2025 that stated the implication precisely. Unrealized losses could increase institutions' vulnerability if other developments, such as a substantial surge in commercial property loan losses, make depositors question an institution's viability. That's not a theoretical construction. It's a description of what's actively accumulating in the commercial property sector currently, which happens to be the segment most concentrated in the loan portfolios of regional and community institutions. Commercial property delinquency rates for office loans across America reached 10.4% in the second half of 2025, approaching the 2008 maximum and representing the fastest acceleration of increase in this data series on record. Regional institutions maintain approximately 44% of their total loan portfolios in commercial property compared to 13% at the largest institutions. New loan level research published in late 2025 discovered that latent distress in commercial property, meaning loans that would be underwater at current property valuations, even if they're not yet formally delinquent, is approximately 4 times larger than what current delinquency statistics indicate. The institutions aren't recognizing these losses yet. Extend and pretend, the practice of modifying loan terms and extending maturity dates to avoid formal default recognition, is masking the magnitude. Exceeding $1 trillion in commercial property loans were scheduled to mature by the conclusion of 2025. The maturity pressure extends through 2026 and 2027. When those loans mature, the borrower either satisfies the balance, refinances at current assessments, or defaults. There's no fourth alternative. Refinancing at 6 to 8% on a property that has declined 30 to 40% in valuation is not economically viable for most commercial borrowers. The extend and pretend window has a hard boundary, and when it closes, losses that have been accumulating for 3 years will require recognition. Here's what that recognition event appears like from a depositor's perspective, walking through the progression step by step because the sequence of events is as significant as the events themselves. A regional institution with concentrated commercial property exposure initiates reporting elevated loan loss provisions. This materializes in its quarterly earnings. The investment community flags it as a credit quality concern. An analyst publishes a note. A local financial journalist acquires the narrative. Within 24 to 48 hours, depositors maintaining uninsured balances exceeding $250,000 initiate calling the institution. Some initiate relocating resources. The institution's overnight funding position begins deteriorating. The institution's treasury team activates its liquidity contingency plan and initiates drawing on Federal Home Loan Bank advances to supplement its short-term currency position. One of the instruments in that contingency plan is the 7-day notification clause. The institution doesn't require a regulatory order to utilize it. It doesn't require declaring an emergency. It doesn't require making a public announcement. It activates an authority that has existed in its deposit agreements since the accounts were established. Customers receive a written notification. Withdrawals are postponed. The institution has acquired itself 7 days to source alternative funding, to negotiate with regulators, to explore a sale or consolidation, or to prepare for a formal FDIC resolution procedure. From the depositor's perspective, the notification is the first visible signal that something is problematic. But the institution's portfolio stress didn't initiate the day the notification materialized. It initiated months or years earlier, accumulating through unrealized losses, deteriorating commercial property performance, and compressed lending margins. The notification isn't the beginning of the challenge, it's the moment the challenge becomes impossible to manage privately. Let me now be precise about what the FDIC's actual capacity is in this scenario, because there's a widespread assumption that the insurance mechanism provides a complete backstop, and that assumption doesn't survive contact with the actual figures. The Deposit Insurance Fund maintained a balance of $150 billion as of the third quarter of 2025, representing a reserve ratio of 1.40%. That indicates the fund covers 1.40 cents for every $100 of insured deposits in the American banking infrastructure. Total insured deposits are measured in the low tens of trillions. The fund is sized to manage individual institutional failures. It's not sized to manage a simultaneous stress event across multiple institutions in the identical sector. The FDIC has been transparent about this constraint in its published documentation. The Orderly Liquidation Authority exists precisely because the fund alone cannot address a systemic scenario. In that scenario, the resolution procedure relies on the bail-in mechanism to recapitalize failing institutions using the institution's own liability structure, including uninsured deposits, rather than drawing down the fund. That's why the framework exists. It's the FDIC's institutional answer to the question of what transpires when the insurance pool isn't large enough. And the answer is that uninsured depositors become part of the recapitalization. Now let me connect this to the actual mechanics of what you maintain positioned in a deposit account, because the gap between how most depositors conceptualize their balance and how the legal infrastructure categorizes it is worth understanding clearly. When you deposit capital at an institution, you're not placing your capital in a vault for safekeeping. You're making an unsecured loan to the institution. The institution accepts your deposit, records it as a liability on its portfolio, and deploys those resources into loans and instruments. You become an unsecured creditor of the institution. You maintain a claim against it for repayment. That claim is subject to the terms of the account agreement, to applicable regulations, and in a resolution scenario to the priority hierarchy established under federal law. For balances exceeding $250,000 per depositor per institution, there's no insurance backstop. You're an unsecured creditor. In an orderly liquidation proceeding, your claim ranks below the institution's derivative obligations, below secured debt, and alongside other uninsured depositors in a recovery procedure whose timeline and outcome are determined by the FDIC as receiver, not by you. Most individuals don't conceptualize their deposit account this way because they've never had to. The question this presentation is asking is how much longer that remains accurate. The pattern that connects 1933 to the 1980s thrift institution emergency to 2008 to the regional institution stress of 2023 to the current environment is consistent across all of them. Debt accumulates against asset valuations inflated by the debt itself. The interest assessment environment that enabled the accumulation transforms. Asset valuations decline. Concentrated loan portfolios at regional institutions initiate generating losses. Depositor confidence at those institutions deteriorates. The most mobile depositors relocate first. Their relocation accelerates the deterioration of confidence for everyone else. The progression accelerates. What's different in 2026 isn't the pattern. What's different is the legal infrastructure that was constructed specifically to manage this progression once it becomes visible. The 7-day clause, the bail-in framework across 24 jurisdictions, the Orderly Liquidation Authority under Dodd-Frank. This infrastructure was constructed following 2008 by regulators who had observed the identical progression materialize and decided that the next occurrence, depositors exceeding the insured threshold, would absorb losses that previously fell on taxpayers. That's not a sinister conspiracy. It's a deliberate policy determination made publicly, documented in legislation, and it's been in place for 15 years. Most depositors simply haven't examined the documentation. Here's what the practical implications are stated as a framework rather than instructions. Understanding your actual coverage represents the starting point. If you maintain more than $250,000 at a single institution, the excess is uninsured regardless of the institution's apparent stability. The FDIC's institutional lookup instruments are public and free. Distributing deposits across multiple FDIC-insured institutions to remain within the insurance boundary at each is straightforward. Understanding that joint accounts and retirement accounts have separate coverage calculations is part of that picture. Understanding what tangible assets outside the banking infrastructure represent in this context is the second consideration. Gold and silver maintained in tangible form in your possession or allocated segregated private storage that exists outside the banking infrastructure are not subject to the 7-day clause. They're not subject to orderly liquidation authority. They're not part of any institution's liability structure. They exist entirely outside the claims hierarchy that governs everything else described in this presentation. Central banks globally acquired record quantities of gold in 2024 and continued accumulating through 2025. China, Russia, India, and sovereign wealth funds across the Middle East have been systematically establishing gold reserves. These are institutions with the analytical resources and regulatory access to understand precisely what exists on the portfolios of the Western banking infrastructure. They're not acquiring gold because they anticipate a collapse next week. They're acquiring gold because they're managing against the tail risk of an infrastructure that their own analysis tells them is under structural stress. They're executing precisely what the legal infrastructure of the infrastructure suggests is rational for any creditor who wants assets that cannot be converted or postponed. Silver trading at a significant discount to its historical ratio relative to gold faces additional supply constraints from industrial demand in solar manufacturing, electric vehicles, and defense applications. Physical silver demand has been exceeding annual mine supply, and above-ground inventories are at multi-decade lows. The monetary case and the industrial supply case are both present simultaneously, which is an unusual combination. The third consideration is timing and optionality. The decisions above, reviewing your deposit coverage, understanding the legal infrastructure of your accounts, establishing a position in assets outside the infrastructure, don't require an active emergency to justify. They require only an accurate understanding of the structure you're currently inside, and they become materially harder to execute once a confidence event is underway at a specific institution, because by then, the progression is in motion, the queue is forming, and the 7-day clock may already be running. Here's where we are stated with the precision the available metrics permit. Institution portfolios across America carry close to $500 billion in unrealized securities losses based on the most recently published figures representing approximately 20% of aggregate banking infrastructure equity. Commercial property office delinquencies are approaching 2008 maximum levels at the fastest acceleration of increase ever recorded in this data series. Regional institutions maintain nearly half their loan portfolios in commercial property. Latent distress in that sector is estimated to be 4 times larger than formal delinquency statistics currently reflect. The FDIC Deposit Insurance Fund has a 1.40% reserve ratio above the statutory minimum, but not sized for a systemic event. The bail-in framework is legally active across all major Western economies. The 7-day notification clause is positioned in your deposit account agreement currently, available to be invoked without external authorization, without a public announcement, and without any headline to warn you it's approaching. What's not yet determined is the specific trigger. It's not known which institution, which earnings documentation, which commercial property maturity default, or which external shock will convert this latent stress into a visible progression. A Stanford finance professor who studies institutional fragility stated it directly in May 2025. The ingredients for stress are still present, especially if macroeconomic conditions deteriorate. He's describing an infrastructure that's loaded, not one that's discharged. But a loaded infrastructure and an unloaded infrastructure require different responses from the individuals inside it. The investors and depositors who came through the banking panics of the 1930s, the thrift failures of the 1980s, the financial emergency of 2008, and the regional institutional failures of 2023 were not the individuals who relocated the fastest after the headline materialized. They were the individuals who understood the structure before the event, who examined the actual account agreements, who recognized that a quiet clause buried in a regulatory definition isn't a footnote. It's a feature that was deliberately designed and can be deliberately utilized. Your deposit account isn't a vault. Your deposit is a liability on a portfolio. The insurance protecting it has a cap and a fund with quantifiable limitations. The legal framework governing what transpires if the institution maintaining your deposit encounters stress has been redesigned since 2008 to protect the infrastructure first and the depositor second in that sequence by explicit statutory design. This isn't the conclusion of the progression. The next data points will materialize in the approaching weeks and months. I will be tracking the FDIC quarterly banking profile when it publishes. I will be tracking commercial property maturity metrics, regional institution earnings disclosures, Federal Reserve portfolio reporting, and any regulatory filings that indicate specific institutions are approaching the stress thresholds discussed today. Because the progression described in this presentation doesn't resolve in a single news cycle. It develops over months. Each stage will be visible if you know what you're observing. Stay with this channel, because the next development in this progression isn't a prediction. It's a disclosure that has already been made somewhere in a call report, in a regulatory filing, in a quarterly earnings footnote that hasn't yet become a headline. The job of this channel is to locate it before the headline does. The only question that remains is whether you're observing this unfold from inside the infrastructure without understanding the regulations, or from a position you chose deliberately because you examined the fine print. Let me add one more dimension that most financial commentary skips entirely, because it's the dimension that explains why this time the progression cannot be resolved the way it was resolved before. In every previous banking emergency, there was a backstop of last resort. In 1933, it was the creation of the FDIC itself. In the Thrift Institution emergency, it was the Resolution Trust Corporation funded by federal appropriations. In 2008, it was the Troubled Asset Relief Program, $700 billion in congressional authorization, combined with the Federal Reserve expanding its portfolio from under $1 trillion to nearly $3 trillion in a matter of months. In 2020, it was a combination of zero interest assessments, $4 trillion in new Federal Reserve asset acquisitions, and direct fiscal transfers to households and businesses at a magnitude not seen since World War II. Each of those interventions functioned because the conditions for them existed, the fiscal capacity was available, the political consensus for intervention was achievable, and the starting point before the emergency meant that the monetary and fiscal instruments had room to function. The starting point today is different in a specific and measurable way. The United States federal debt stands above $36 trillion as of early 2026. The interest payments on that debt are running at an annualized rate that exceeds the entire defense budget. The Federal Reserve's portfolio, even after the quantitative tightening that initiated in 2022, remains over $7 trillion. The Fed funds rate has been maintained at 3.5 to 3.75% as of the January 2026 FOMC meeting, with inflation described in the Fed's own statement as remaining somewhat elevated. What this indicates is that the instruments available in 2008 and 2020 have limited room to function today. Reducing rates to zero again would require the Fed to accept that inflation, which is already elevated, will increase further. Expanding the Fed's portfolio through new asset acquisitions would add to a portfolio that's already historically unprecedented in magnitude. And congressional authorization for another TARP-style program would require bipartisan political consensus on fiscal spending in an environment where the national debt and its interest expenses are already a primary policy concern. This isn't a prediction that the instruments won't be utilized. Central banks have repeatedly demonstrated a willingness to expand their intervention toolkit when the infrastructure is under sufficient stress. But the starting conditions determine the expense of the intervention, and the expense today is higher than it has been in any previous emergency, which indicates the resolution is either more expensive, more inflationary, or requires a mechanism that doesn't add to the government's portfolio. The bail-in framework is that mechanism. It's resolution without new taxpayer capital. It's recapitalization using the institution's own liability structure, meaning the deposits, bonds, and equity that are already on the portfolio. It doesn't require congressional authorization. It doesn't require the Federal Reserve to print new currency. It requires only that the FDIC invoke its existing legal authority under Title II of Dodd-Frank. This is why the infrastructure matters. Not because it will necessarily be utilized, but because it exists. It's the lowest expense option for resolving a systemic banking stress from the government's perspective. And the constraints on every alternative option are higher today than they have been at any previous decision point. The depositor who understands this isn't a pessimist. The depositor who understands this is operating with accurate information about the structure of the infrastructure they're inside. And accurate information acted on before the progression becomes a public event is the only form of protection that the infrastructure itself cannot override. That's where this presentation concludes. Not with a prediction, not with a timeline, with an accurate description of a structure that most depositors don't know exists, constructed on documented metrics that are publicly available and governed by laws that have been on the books for 15 years. The progression has a beginning. It doesn't yet have a conclusion. Watch this channel for the next development.